Hello and welcome to the Global View on this Wednesday here at AusBiz. Thanks for joining us again. Let's get across what we saw overnight and taking a look first. In fact, this is how Wall Street has finished, with those tech stocks making a bit of a comeback, but the software companies remaining under pressure, with CrowdStrike and Intuit falling. Let's get to further details there. We can see those movement there in those particular stocks. Warner Brothers Discovery rejecting Paramount Skydance's latest hostile bid. Paramount has until February 23rd to make a new offer, which Netflix is then allowed to match under the terms of the merger agreement. Consumer staples were among the worst performing on the S&P, dragged lower by General Mills after the cereal maker cut its annual core sales and profit forecasts. Medtronic beat expectations for third quarter profit and revenue, driven by a strong demand for its heart devices, but left its forecast for full year adjusted profit unchanged. And Norwegian Cruise Line, those shares surging after activist investor Elliott said it had built a more than 10% stake in the cruise operator. Well, Britain's jobless rate rose to 5.2% in the last 3 months of 2025, its highest in more than a decade outside of the pandemic period, while wage growth slowed further, bolstering prospects of an interest rate cut next month. And Germany's economy is expected to grow by 1% this year. That's more than the 0.7% previously forecast, while the country's inflation rate has edged higher to reach 2.1% in January. In the US, the Empire State Manufacturing Survey weakened, while the Home Builder Sentiment Survey also slipped. US Treasury yields have risen from multi-month lows, the 2-year rising to 3.44%, the 10-year was up to around 4.06%. The Aussie 3-year government bond yield had fallen to 4.25%. US dollar index up close to 0.5% on the day, the Aussie trading at 70.8 US cents. Oil prices have fallen to 2-week lows on easing tensions between the United States and Iran, with the Iranian foreign minister saying the countries had reached an understanding on the main guiding principles of their nuclear talks. Brent futures down around 2% to $67 a barrel. Gold has tumbled as those US-Iran talks dampen safe haven demand. Spot gold down more than 2% to under $4,880 an ounce. And Bitcoin currently trading below 68,000 US dollars. Let's get across those moves, particularly on Wall Street. Joining us, Ganti is the Senior Director, Index Investment Strategy at S&P Global. Anu, terrific to have you back on the show. So, as we have seen more recently, those software stocks remaining under pressure as investors look to rotate more broadly out of the tech sector. How are you seeing that play?
Yes, I think you nailed it right there, Andrew. It's great to be back, and we're watching software and services very closely, along with the interaction of broader tech. And if you look at the numbers, for example, we have our software and services select industry index down 9% month to date, relative to the 3% decline in the technology select sector index. So some heavy weakness that we're seeing within this segment of the market. I will say that volatility is top of mind right now, and we've been looking closely at the market's expectation or implied volatility, and we've actually found some interesting results. If you look at tech implied volatility relative to X-Tech using our S&P 500 X Technology Index, we actually found that the implied volatility of tech was higher relative to the rest of the market, which probably tells us that there might be some jitters here to stay in the future. So that is something that we're watching. You also brought up rotation. And the big rotation is something that we're looking at, the pullback in tech, defensive sectors outperforming, like consumer staples and utilities, for example. And of course, consumer staples had a tough day today, but that is the trend that we're seeing. Also, the rotation towards small caps and the rotation towards value. The question is whether this broadening of the rally will stick. And we're looking ahead to the Fed minutes on Wednesday, whether another potential cut is in order, and of course, NVIDIA earnings later.
So you talk about that rotation out of tech into the broader market, in particular small caps, obviously as investors also seeking value. So How are investors making those decisions in terms of sector allocation at the moment, do you feel?
Yes, it's an excellent question when thinking about stock selection versus sector allocation. And I think diversification is top of mind right now. And what we've seen is historically, we've looked at the correlations among the sectors, and we found something interesting, which is relatively low correlations of tech versus other sectors. For example, if you think of our GIC sector complex, which tells you that sectors can potentially be used as a toolkit when thinking about diversification and again reducing that volatility. Also, if you think back to the idiosyncratic risk in the market, we have our S&P 500 top 10 index, which of course includes the Mag 7. And you would think that with all the jitters in the market, that volatility would have gone up. But volatility actually declined within the top 10. And that's again because of those lower correlations and higher dispersion, a higher spread of returns. So it's really important to look under the hood, for example, with a cumulative 75% performance differential between the Mag 7 outperformers and underperformers. And that's very different to the environment in early April with the tariff-related tumult when correlations were relatively higher and dispersion was lower. So a very interesting time to be looking at sector rotation, the environment right now with the tech pullback, with defensive sectors moving ahead. We did see last year that only a couple of sectors beat the S&P 500. That has broadened considerably so far in January and early into the early innings of February so far. So an interesting time to be looking at this movement into the more defensive segment of the market.
Well, are we seeing any sort of seasonality at play here? It's often said that January and February set the scene or set the tone for the rest of the year. I mean, is that how are you seeing that at the moment, given that volatility, I guess, that's at play?
Yes, no, that's an excellent point, right? And it's important to understand because we're already in mid-February right now, so we're looking closely ahead to the Fed and the Fed's future interest rate trajectory, as that's going to have an important impact across the stock selection environment, across the sector rotation environment. Of course, factors come to mind as well, and we've seen that our low volatility indices have outperformed relative to high beta and momentum, for example. But to your point about coming back to January and whether January and how it goes for the rest of the year, we will be looking ahead to other macro indicators and of course midterm elections later this year in the U.S. Because historically we've seen that during these election environments we see that greater sector dispersion. We're getting the sector call right might be more important, in fact, than getting the stock call right. So it certainly looks to be an interesting year.
And I know, given that rotation out of tech, perhaps we shouldn't be surprised that that has clearly weighed on both the S&P and also the Nasdaq, whereas the Dow has actually performed well, having eclipsed that 50,000 point level, I should say.
Yes, no, that's an important point, an important milestone that we've celebrated. And the Dow is fascinating to watch with almost 130 years of live history of these blue chip companies, and especially coming back to the point of defense being top of mind right now. The Dow can be really useful as a barometer of what's ticking in the market day to day. So super timely to watch. And it's also been fascinating to see the growing index-linked ecosystem surrounding the Dow with roughly $8 trillion in volumes in index-listed products. So it's certainly been an evolution over more than a century.
I know, terrific to get across what you're seeing on Wall Street at the moment. Thanks for joining us from S&P Global.
Thank you so much.
So let's turn our attention to the local market. Just ahead of the open, we're expecting a positive move there. As you can see, SPY futures up close to 0.5%. Lots of results to get across, including NAP. It's out with its result, having seen a decent bump in its quarterly profit there. This is unaudited, given that it's just a quarterly update. Many other companies in Suncorp also, that's been under pressure too because of weather-related events. We'll get across that and much more. Also expecting the wage price index out this morning as well. Join us in just a moment for the open.